Welcome. Thank you guys for joining. Welcome to the LemFi Masterclass series. Today, just going to introduce LemFi to you. For those of us on here that do not know LemFi, bumping into LemFi for the first time, we're not going to assume that everyone knows us, even though we know that a considerable number of you know and use LemFi. So just for an introduction, LemFi was founded in 2020. With one goal, which was to simplify international payments for everyone across the world. LemFi is currently licensed to operate in both the UK, Europe, US, and Canada. Beyond the UK, fun fact is people can also send money from Europe, US, and Canada to various African countries like Ghana, Nigeria, Rwanda, Tanzania, Kenya, Benin. So any one of the countries listed here, if you have friends from those countries, you should let them know. They can send money with LemFi through those other African countries. With LemFi, Africans in the UK, Europe, USA, and Canada can send money home at the best rate within minutes and at zero transaction fees. For people that have never used LemFi before and are new to LemFi, this is your first time on here, you can download the app. It's available on Google Play Store and Apple App Store, or you can simply download using the referral code. And as a first timer joining us and download the app for the first time, when you sign up with the code webinar, you get a £10 cashback on your first transaction above £50. So if you're on this call and you don't have LemFi and you would like to download it, visit your Google Play Store or your Apple App Store and download using the referral code webinar, and you get a £10 cashback on your first transaction above £50. There will also be reward points towards the end of this. So if you're joining, make sure to stay till the end, because we're going to be giving out 5 goodie boxes to 5 lucky winners, and you just have to stay to the end and participate. Bonus points for people that use LemFi. So if you don't have LemFi, you might want to download it and sign up before the end of the session, as there'll be prize. So let's get to why we're here. Today we're going to be having our speaker, Ripley. Ripley is the founder of First Time Finance, and today we're talking to us about how to buy your first house in the UK as a foreign national. So as a national in the UK, foreign national with a visa, however, Ripley's going to be talking to us about how to buy a first house in the UK. Is the founder of First Time Finance, a company driven by the belief that buying a home, particularly for visa holders and first-time and foreign nationals, should be easier, more personal, and more accessible. In 2023, after witnessing the challenge that foreign nationals faced when securing a mortgage in the UK, decided to create a company to solve that problem. They saw a gap and created a company to solve it. And today, his company is recognized as the go-to specialist for helping foreign nationals and visa holders successfully navigate the UK mortgage market. So I'm just going to be bringing Ripley on stage right now to take it up. Hi, Ripley.
Hello. Perfect. Thanks for the introduction. It's good to learn about LemFi as well. I think I might have to try and get hold of one of those goodie boxes. Perfect. Thanks. So what I'm going to present to you all today, it's obviously a pleasure to be here and present with LemFi, is about how you can actually buy your first home in the UK as a foreign national. As Simi just mentioned, of course, the reason I started First Time Finance was because I saw that this had become a problem. Too many people were being given the wrong advice. So I want to be here today to give you that right advice and the right information. Now, at the moment, before we get started, I feel like there's something that I want to talk about and give you my thoughts on, considering kind of some of the news that's come out over the last week or so to do with the immigration white paper. Now, I'm not an immigration law specialist, but this is something I do feel very strongly about. And as the founder of First Time Finance, I, of course, spend pretty much every day speaking with people that have migrated over to the UK that are trying to make a home here. And I can say firsthand, they're not here to just work. They're not here to build. They're here to build, belong, contribute, and of course to settle down, and of course buy homes as well. And that's why the latest immigration white paper frustrates myself, because it shows a bit of a shift in tone from obviously welcoming people with potential to giving extra barriers. And to me, that's not right. Of course, our economy depends on people who move here, grow here, and put down roots. And quite often, those roots are first planted securely through housing, right? So owning a home here is much more than just bricks and mortar. It's also a signal that you're staying, contributing, and building a life here. And at First Time Finance, our message to our people is very simple. You belong here, you deserve a home here, and we will help you fight for that as well. So you'll be glad to hear that the immigration white paper that's come out doesn't affect anything to do with home buying or mortgage lenders or what's available on the mortgage market. So just to give you some of those thoughts, but without further ado, I'll get into the webinar that I've promised of how to actually buy your first home here. Now, on this webinar, what you're going to learn is how to actually figure out how much you can borrow. So based on your visa, income situation, etc., how much you can borrow. You'll also understand how much deposit that you need. So these will be realistic expectations, not just estimates or misinformation that you might see online. You'll be able to see how credit affects your chances of approval. And you're also going to understand all of the key steps in the process as well. Now, before I start, I like to talk about the problem. So why is it so hard to buy your first home in the UK as someone that's moved over here? Because in my opinion, it really shouldn't be. The problem that I saw was that quite often, even advisors, so professional mortgage advisors or even banks, were saying to people that you need a 25% deposit to buy here, or you need to have lived in the UK for a number of years. Now, that first part is just not having any clear guidance, right? So it's not having anyone that's there to give you that right information at the beginning. There's then also confusion about visa requirements, right? And this varies a lot from each lender to another. So you could walk into your bank, for example, and they would say, oh no, you're on a visa, so you can't get a mortgage. But that's not then representative of the entire market. There are also limited lender options. So as I've just mentioned, one bank might say no, but that is the case for a large percentage of banks when you're on a visa in the UK. But that's not to say that no banks can give you a mortgage. Now, it's very likely that if you've only been living in the UK for a couple of years, you're going to have a thin credit profile, right? So you might not have credit mistakes, but you're not going to have the largest or best credit profile if you've only been living here for a couple of years. So that can be something that gets in the way as well. The last point would be higher deposit expectations. Now, this can be a common misconception, and it's definitely something that's said a lot, is that you need a very, very large deposit in order to buy. It can be the case, but it just depends which lender that we're going with. So what is the solution to this? And this is something that we've brought to the market over the last couple of years, year and a half. And this is being here to ensure that you're getting specialized advice that is exactly correct for you. So this is exactly how we help our clients succeed. So the first point is expert advice in this area. So we understand the visa requirements, we understand how much deposit, how long you need to have lived in the UK, etc. It's giving step-by-step guidance. So that doesn't just mean advising you on the mortgage, but it also means taking you step-by-step throughout the process to ensure that you don't run into any costly mistakes. It's having access to specialist lenders who will understand your visa and your situation, because not all lenders are going to be perfect for you. It's also providing you with the right education. And I guess this is exactly what's happening now. And I do really believe that knowledge is one of the first foundations that you can have to then push you on to being able to go through this process without making those costly mistakes. The last point would be preparing the finances, right? So there's many things that you can do to prepare, and I'm going to give you some of those on this webinar so you can start to prepare for the next steps after this. Now, what I want to start by talking about is what I call the 4 key pillars of getting a mortgage in the UK. So you'll see these on the screen here. Now, it can be quite confusing when you think about a mortgage and how you're actually going to get that arranged. And don't get me wrong, mortgage lenders ask hundreds of questions, right? So it is a complex process. But I want you to simplify that in your head by just looking at these 4 things on the screen now. And these 4 things are essentially what mortgage lenders are looking for. So the first pillar is residency status. So that can be the type of visa you're on, how long you've lived in the UK, how long is remaining on the visa. You've then got the deposit. You've then got your income. So that is whether or not you can afford it and how much you can afford. And then finally, you've got the credit profile side as well. Now, I'm going to walk you through each of these step by step so you understand them in depth and what the requirements actually are. So the first one is the visa or residency status. So the first point is you can definitely get approved for a mortgage when you're on a visa in the UK. It's something we do with all of our clients. So this isn't necessarily a barrier. So what are lenders actually looking for when it comes to visas? So the first one is the visa type. So the visa types I've put on the screen are very commonly acceptable. The skilled worker visas, health and social care, graduate visas, spousal visas, even dependent visas. And there are a few other types as well that can work, like global talent, for example. The next is how long you've actually lived in the UK. So as a rough guide, if you've been living in the UK for less than 12 months, the options are limited, but it's still possible. Once you reach at least 12 months in the UK, a lot more lenders open up. And that also includes some that can accept 5% of the property value deposit. And I'll come back to the deposit side a bit later on. The next part is actually the time remaining on your visa. So most lenders require at least 6 months to be remaining on the visa, but some even have a 12-month minimum. However, there are a few lenders who can accept less. So we're working with a client at the moment that's only got about 2 months remaining on their visa. You might think that doesn't sound like a great idea, but they do have an extension that is beginning to be processed. So they know they're going to be able to stay for longer. We can't quite prove that to the lender yet, but they're still comfortable with it because we've put the case forward to them in the right way. Now, the next pillar is the deposit. So I've already mentioned a couple of times, and I'm sure you might have heard this before, this whole 25% deposit. I'm not quite sure why so many people believe this, but it is written all over online. So if you Google, can I get a mortgage with a visa? That's probably going to come up somewhere is that you need this 25% deposit. And the fact of the matter is, the majority of lenders do actually require 25% deposit, right? But there are still plenty that we can go to who don't have that requirement. So the minimum deposit when you're on a visa, if you're purchasing in England, Scotland, or Wales, can actually be as little as 5%. 10% deposit is a much better target. And the reason for that is that you get much better interest rates. So that will help with things like the monthly payments, of course, being a lot more affordable too. Now, something that's always good to mention when we're speaking about deposit is how you can raise it. So one of the clever things you can do if you're interested in new build properties is potentially get an incentive from the developer. So if you have a 5% deposit yourself, so to make the numbers easy, imagine you're buying a property for £100,000. I know it's impossible to find a new build property for £100,000, but imagine you can. That 5% deposit that you have is £5,000. So then if you found a new build developer that could also contribute another £5,000 as a deposit incentive, that of course then equals a total of 10%. And what that then enables you to do is get access to lenders and interest rates that you would only be able to get if you had a 10% deposit yourself. But in this instance, you're only using 5% plus then the developer's 5%. Now, the source of the deposit also matters a lot. So this is something we run into all the time is, what can I use as my deposit source? Is it okay if I've got funds coming from abroad? So initially, the best source of deposit that you can use is savings, right? So that's money that you saved up through working preferably in the UK. To go a step further than that, if you have funds coming from abroad, that's fine for most lenders as well. But we need to be able to prove where that's actually come from. So whether that's the sale of a property or land abroad, or you've saved it up abroad and now you're sending the funds over here, a very important thing to note is that that money needs to be sent to yourself. So I guess a good example of this would be through a platform like LemFi, right? So you're sending it through a verified source instead of potentially sending money through someone else, where that chain of the money is then going into someone else's name and then back into yours. The reason for that is because it's very difficult to then verify where the source of those funds has come from, because you're sending it through someone else's account. So that's just something to be very careful of. Another thing is through using revolving saving schemes, or you might call it ajo or thrift. So obviously where you're saving up with community, whether it's colleagues or friends, that is also unacceptable to lenders to use. So if we actually go to a mortgage lender and say that's the source of deposit, then they would actually decline it. And it's the same for solicitors as well. So if they know that to be the source of deposit, they're told by the mortgage lender to decline it. Quite commonly we get asked, why is that actually a problem? And it's really because you can't verify the source of where the money's come from. So although you might have sent the money to someone else over the last 6 months, and then you're getting a lump sum back in, or you're getting 6 colleagues sending, let's say £500 back into your bank account, it's very difficult to actually prove the exact source of that money. So that's something just to be very careful about. And we have seen people be told that they're unable to proceed much later on in the process just due to this. So although I've definitely heard from people that it's possible to use, and I made a TikTok video about this once, and I don't think people were particularly happy, and they were telling me that they have used it before. I wouldn't rely on it, because if you get too far down the line, you could have spent thousands and it could all come crashing down. So I'd say just be very careful about that. Be very clear, solicitors are typically looking at the last 6 months bank statements when they're verifying your deposit, but some might even look at the last 12 months. Now, the next pillar is income, right? So with income, it's more than just the salary amount that you've got. And when we're talking about income, really what we're talking about is the affordability. So this is how much of a mortgage can you actually get. So the key considerations here are how much and how you're paid. So for example, when we're saying how you're paid, is it an hourly rate that you're currently getting paid? Do you have a minimum amount of hours in your contract, or is it classed as a 0 hours contract or agency? How much is the total when we're looking per year? Do you have any overtime? What's the contract type? There are so many things that come into this. They're then looking at your expenditure as well. And mainly it's your committed expenditure. So that can be things like loans and credit cards, it could be childcare costs and dependents as well. Now, as a rough guide, and it's very difficult to say on this call exactly how much you can all borrow, but as a rough guide, you can typically borrow somewhere between 4.5 times to 5 times your gross household income. So that means your pre-tax household income. So that could be just your income, or it could be your income and a partner's income as well. Now, the last pillar, so the fourth pillar, is credit profile. So at this point, we've understood visa status, visa type. We've understood the deposit side, what you can use, how much you might need. We're understanding, okay, how much you might be able to borrow and what comes into that calculation. But the last point here, being the credit profile, is one that sometimes people run into as an issue or are just very, very unsure on, and it can even make them very hesitant to proceed. So really, what are lenders actually looking for? I would summarize this by saying a lot of clients ask me a question saying, what is the right score? What's the perfect score? What credit score do I need? Unfortunately, it doesn't work as simple as that. And that is because there are many different credit reference agencies. So the examples on the screen of Experian, Equifax, TransUnion, they use unique and very different scoring models. So there really is no perfect score. You might have a 500 score somewhere, which is good, and then it could be a 700 score elsewhere, and it's not so good. So it does make it rather complex. One of the main things is ensuring that you don't have any credit mistakes, because lenders are looking past the score. They're not just looking at the score, they're also looking at your entire profile. So this would be things like defaults, county court judgments, missed payments. So they're looking at how you've used credit facilities before in the past as well. Now, the best way to actually understand can you get a mortgage or not with your credit profile is through doing an agreement in principle. I'll be very clear when I say this. There is a big difference between doing an agreement in principle online, where you put in a few details and it gives you a certificate, versus working with a mortgage broker who will look at your documents, do all the assessment, go to the right lender, and get the credit check hopefully approved. But through doing that, you would then understand if you pass that credit check or not. If you are, let's say, more than 6 months away from wanting to actually start looking at properties, then a much better earlier step you can take is actually just downloading a copy of your credit report. The credit report agency that we normally recommend to use is Check My File, and that's because they use the 3 main credit reference agencies that lenders use, and it gives you a kind of blended score, if you like. And you can look at that very clearly to see if there are any issues on there, if there's anything you need to rectify or improve. So if you're much further away from wanting to start this process, that might be a more appropriate first step to take. So what I wanted to give to you on this is a couple of common mistakes that we see. So hopefully then you can actually avoid those and not make those same mistakes. So the first one is not working with a specialist advisor. So unfortunately, generic brokers or brokers that just work with all clients commonly miss key details to do with visa holders. So you really do need a specialist. I'm not just saying that because that's what we do. It's more the fact that I've seen that that's the issue. Hence, that's why we do what we do. Because we still speak to clients all the time that have either got declined when going ahead with a mortgage application, or just not able to get an agreement in principle in the first place. And this is the reason why. The next really big one would be missed payments on your credit profile. So things like utility bills or mobile phone bills, these are very common to have issues with. And it can be as simple as, if you're moving home and then you need to change utility bill company, the one that you had previously hasn't been shut down properly, and then it gets registered as a missed payment, even though you've cancelled it. So you have to be very careful when changing things like that to ensure that it's not then registered as a missed payment. Now, I'm not here to say, okay, one missed payment is going to completely eradicate all your chances of getting a mortgage, but it can have a major effect, right? So there are normally lending options we can go to, but if you have some missed payments, it can sometimes stop us from going to the cheapest lenders, which might mean you then have more expensive interest rates. Again, you're not going to know for definite until you go through the process of getting an agreement in principle. The last one would be poor deposit planning. So this can just make things a lot more difficult. So it's much easier if you make sure that when you're going to go through the process, the last 6 months bank statements that you've got your deposit in show a clear build up of what the deposit funds are. If you're going to have a gift coming in from anyone else, ensuring that it's from an immediate family member, so like a sibling or a parent, and that you can show where that money's come from, because the solicitors are going to verify this very carefully later on. So it's extremely important that you have the proof of that, and not preparing that can be a huge issue. So I wouldn't be doing you justice of telling you how to buy your first home in the UK if I didn't walk you through the home buying process. It's important to mention that the home buying process in England and Wales differs to the home buying process in Scotland. So I'm going to focus on the home buying process in England and Wales for today. But of course, a lot of these points within this are still the same. It's normally just some changes in terminology and some slight changes in timeframes. So the first step you want to take, let's say you've kind of built up your deposit, you know you're wanting to go ahead and start looking at properties, you're unsure what to do. The first step you want to take is this, is getting the agreement in principle in place. Quite commonly, what we might see is people jumping to step 2, which is where they start doing the viewings, they go out, want to find the property, and then later they find out that they run into an issue. So if you do step 1 first, Speak with a specialist advisor, look to get an agreement in principle. They can assess your documents, make sure that you're not going to run into issues later on, and they can go to the best lender for your circumstances and get that agreement in principle in place. Then what happens next is you want to go out and start doing viewings, right? So you want to start having a look at properties within that budget. The first step of that is looking on Rightmove and Zoopla. Also On the Market is another website that you can look at. And I would start fairly broad, right? You'd need to find a property that's, I guess, near your place of work, potentially near your kids' schools, but you can start a bit broader and then start to narrow that search down. Once you've got a good idea of exactly what you're looking for, you can then go out and start doing viewings. And you can start to look at these properties and see if there's something that you'd like. At a certain stage, I'm sure you'll find something that you really like, and then you would want to put an offer forward on one of those properties. So there can be a process of negotiation here. It does depend on the property that you're buying. If it's a new build property, then quite commonly they will just go for the price that they're put on the market for. If it's non-new build, then there can be negotiation. So for example, if the property was on the market for £350,000, let's say you might be able to offer less, something like 325 or 330,000. Now, whether or not that gets accepted will completely depend on how much the seller really wants to sell that property, so how desperate they are, and also how long it's been on the market as well. Of course, if that's only just come onto the market, it's very unlikely they're going to want to sell that property straight away at a price that's less than what they've listed it for, right? If it's been on the market for a couple of months, they've had no interest, then that's when you start being able to have the potential opportunity to have an offer accepted for less. Now, at this stage, let's say your offer is accepted on the property. There's going to be quite a lot that happens at this stage where the estate agent, they're going to need some documents from you to prove deposit source, ID, solicitor's details you're going to have to get together at that point. And then the next step is looking at pushing ahead with the mortgage application. So step 4 is where we would apply for the mortgage, right? So let's say you go ahead for a mortgage application. Getting the mortgage offer normally takes about 2 to 3 weeks. And what happens during that process is the bank is verifying everything that has been said on the application by looking at your documents. They're looking at the income, they're looking at identity verification, bank statements, deposit proof, etc. The other part of it is verifying the value of the property. So most lenders will do a free valuation. So they normally would send someone out to the property to have a look at it, and they're making sure it's worth the amount you're paying for it. Now, this is really good for you because it makes sure that you're not going to overpay for a property. They're not just doing it to be nice, though. Really, what they're thinking is long term, if you couldn't keep up with your mortgage payments, they do reserve the right to be able to take the property back, right? That is the ultimate risk. So then they're looking at, okay, could we sell this property for what we need to get our money back? But as I said, it still benefits you. The next step of the process is then the legal process. So once we got the mortgage offer through, your solicitor begins a lot of their work. So there's a few things they do. They'll do searches, which is essentially looking at the background information of both the property and the local area as well. They're making sure that there's no issues with that. They might have some questions that they go and ask to the seller's solicitors, which is essentially what they call inquiries. Once they're happy with everything, they would then draft the initial contracts. And the contracts are, of course, what is laying everything out in law that this property is going to be yours, that you'll then sign your name against. It's also important to think about at this stage whether or not you would want to get a survey done. So a survey is where someone would go out to the property, very similar to the valuation, but it's much more in-depth. And they would actually provide you with a report to let you know anything that might need doing to the property in terms of work, and also how urgent that might be as well. It's very important that you do that before you exchange contracts. Exchanging contracts is the point you become legally tied into buying. And you would only do that once the whole legal process has been done. You've got the mortgage offer. You would have done your survey if you're going to do it. And then about here, you would exchange contracts. The next step from there would be completion. So completion, that's where they set a date where you would actually get the keys and move into the property. Important to note that your monthly mortgage payments would normally start the month following completion. So with a lot of lenders, if you were to complete, let's say on the 20th, let's use today, for example, actually, the 22nd of May, you would then pay your first monthly payment on the 1st of June. That might actually be slightly higher than the normal payment. And that is just because you're paying for those few days in May and then also the whole month of June as well. Now, you might be listening to me speaking about this and thinking, okay, this is great, lots of information, but it's too much. There's too much going on. I don't know what to do, how to do it. And this is where we can actually come into the process. So if you check us out online or on our Trustpilot, you're going to see lots of amazing reviews. And we do really pride ourselves in having an amazing service, guides you through the process, and giving you that right advice that's real for you. So if you want to get in contact with us after this webinar, you want to, whether it's just get more information, you want to have a conversation about buying your own home, there's a few ways you can do that on the screen here. So the first one is if you are ready and let's say you're looking to buy a property this year in the next 6 months or 7 months, then you can actually book a free initial consultation with one of our advisors, which includes myself, and you can actually book that on our website. So our website is firsttimefinance.co.uk. What you will also see on there is what's called a mortgage blueprint. And very recently, and actually we only released this yesterday, we recorded a video series. So it's made up of videos that are very similar to this webinar, but they provide far more in-depth information and in different areas. So you're going to understand the exact entire process. It's much more information than I could give you in about 20, 25 minutes today. So that is free of charge. You can literally download it on our website just by putting your email in. So we don't like to gatekeep any information. We'll give it all out to you for free. If you just want to follow along for the journey and find out more and get useful video content, you can follow us on Instagram and TikTok. At Ripley Salgueiro is my personal page, and at First Time Finance is our company page. And you've also got both my mobile number. You can send me a WhatsApp if you like after this. And then you've got our company email there if you'd like to send over some information as well. So that's pretty much all the information I've got for you today, but hopefully I'll see a lot more of you in the future as well. And I'll see you kind of following along for the journey. I'm going to stick around for Q&A as well to be able to answer all your questions, and I'm sure we'll have lots of those as well. But thank you very much.
Thank you so much, Ripley. Such insightful nuggets. I see that some people have been dropping their questions, so I guess we can take questions now. If you have questions, please do well to drop it in the comment section and we'll take them. I think we have a question from Wura, which says, what is a good score for mortgage purposes on Check My File?
I said during the webinar, this was my favorite question. There's no real good score. And I know you specified there on Check My File. I mean, I'd say if you want me to give you an indication, I'd say 700, 750 plus would consider a good score. But that doesn't mean that if you've got less, that it's necessarily a bad score or you can't get a mortgage.
Okay, amazing. Okay. We have a question from Christopher. It says, can I secure a mortgage from a locality different from where I reside?
And it depends how far away it is. So of course, if you're living down south and buying a property to live in up north, questions are going to be asked. So it depends what you're looking to use it for. If you're looking to rent the property out, that's fine, but buy-to-lets do require a 25% deposit, so it's completely different to what we're talking about here.
Okay. I think this person, Mark Darlington, is asking about your services. Before we get into that, I have dropped the link to the website for if you want to book. If you're looking to buy a home soon, just like Ripley had said, you can book a free consultation on this website. But I think this person's asking, do you charge any money for your services?
Yeah, so happy to answer that. We do charge a fee for our service. So our service, which is guiding you through the entire process, mortgage and insurance advice, everything. We do charge a fee. It's £495. You pay it only when we get the full mortgage offer. So we're not charging you anything up front till later on in the process.
Okay, cool. I think we have a person who asks, how do I rectify missed payment issues?
It depends what it's for. So if I used an example during the webinar to do with utility bills and things like that. If it's been a mistake of a company like that, which it quite commonly can be, you can actually sometimes get it taken off your credit report, but you have to take it up with the company themselves and get them to raise that. So if it is a situation like that, maybe push it up that way. If it's the case that you have missed a payment, unfortunately, it will show on your credit report, but just making sure that all future credit facilities are paid on time will just help you to build the credit score back up.
All right. Wumi says, what can you say about shared ownership? Is this an option for immigrants?
Yeah, this is a really good question, actually. So it is possible and it's an option. Yeah. Again, with a 5% or 10% deposit, there are options. I do think buying a property without shared ownership in general is better than buying with, just because you then own the whole property and you benefit from the, let's say, still appreciation of the property. But shared ownership, just to explain it for anyone who's not sure what that actually is, it's where you buy a share of a property. You might buy 50% of the property. On that 50%, you're putting a deposit down and taking out a mortgage. On the other 50%, you're then paying rent. The rent is normally cheaper than what the market rent would be if you were renting from a landlord. So it is a good stepping stone. And it does allow you normally to purchase out the remaining shares. So it's a way of scaling up.
Okay, that's quite insightful. I think Oliver says, does First Finance have properties database a buyer can look for possible purchase? I guess you have a database that a buyer can look at.
We don't, no, unfortunately. But the best places to look with all the live data and the live properties are Rightmove and Zoopla, in my opinion. All of the estate agents, etc., use those to push them out first. So that would be the best place to look.
All right. Solomon says, how many months of statement, the bank statement of my account is required?
So for us, we only look at the last 3 months bank statements, but for solicitors, it's going to be at least the last 6 months.
Okay. Moronka says, what happens if there's a change in my job and I can't meet up with the monthly charge? Maybe I need to reduce what I can afford.
Yeah, so once we've got a committed monthly payment, so let's say for a fixed rate mortgage, your monthly payment will stay the same. That is the minimum amount you can pay the lender in a month. So if you missed, it would get registered as a missed payment on a mortgage on your credit profile, which is quite serious and obviously something we'd want to avoid. So this is something we work with clients initially up front to ensure that we're not giving you a monthly payment that be unaffordable. Um, Potentially things like not being able to work due to illness and injury. That's also something we look at in terms of insurance, and that's a very important thing to be thinking about front as well.
Okay. I think Joy says, can you secure a mortgage at 58?
Yes, you can. You're still young. You definitely can. But people ask me this all the time. Can I secure a mortgage in my 50s? 100% you can. The one thing is it will shorten the mortgage term length. So the monthly payments then become higher. It means you're paying the mortgage back faster though. So that's a benefit. So the affordability side can become, it's not an issue. It's just something we've got to work with. But yes, you can.
Okay. Is it advisable to get a mortgage from my current landlord? He's willing to transfer the property.
I think the question. So I think the question asked, is it buy the property from my current landlord? I believe so. If he's offering you to buy the property, then yes, you can buy the property from them. We would have to go and get a mortgage from a bank as we normally would do. You'd have to put a deposit down of a small amount. If he's willing to give you a bit of a discount from the property, then we can also use that as well. So yes, it's possible. Whether or not it's advisable, I think it depends how much you like the property versus another property that you might buy.
Okay. I think Taiwo says, how will the borrowing limits stated in the AIP stated? I guess you understand.
As in stated as up
As
to, or
up
okay, right, I
to
think I do. Yeah. So yes, it depends on what we base it on. So essentially, an agreement in principle, and this also depends on the lender. Normally, when we're doing it, is going to ask for a purchase price. So it would normally say the maximum you could borrow for that purchase price. Of course, if you're saying I just want to know the maximum we can borrow, then we'll do the calculation beforehand and then give you the agreement in principle for the absolute maximum that you can borrow.
Okay, we have quite a number of questions. But I
Yeah.
think we have
Yeah.
another one from Timmy. Does interest only mortgage applies to first time home buyers as well?
Generally speaking, or technically speaking, yes, they can. But for most people buying their first home, you can't because you need a much larger deposit to get an interest only mortgage. Um, and it's not something we'd necessarily recommend. Interest only is where you just pay the interest. So the monthly payments are less, but you're not paying down the mortgage. So you actually end up paying a lot more interest over the term.
Okay. Someone is asking, do you submit all your bank statement or a statement from the bank you receive your salary paid into?
It's really the bank statements that you use commonly. So we'll look at the bank account that you receive your salary into and your main spending account. And then also, if you're doing the deposit in a different account, we would need to see that as well. So it's income, main expenditure, and then also deposit.
Okay. Olumide says, does your service include solicitor and conveyancing?
So we can introduce or recommend good solicitors, and we do for a lot of our clients. We never force our clients to use anyone. It's our service doesn't include that, so that's a separate thing you have to pay for. But we can introduce or recommend. Yeah.
Okay. Mura says, can a married couple use 10% deposit first time buyer benefits each on separate properties?
I'm gonna have to be very careful with the way I word this because I'm not a tax advisor. I'd say research it online. The answer will come up very easily if you copy and paste that into Google. But I'll put it this way: married couples, as far as I am aware, count as one for tax purposes when it comes to stamp duty. But as I said, I'm not a tax advisor.
Okay. Says, can I secure a mortgage when I'm still paying my student finance?
Yes, yeah, that's possible. So if you got like a student loan coming off your payslip, yes, it gets factored in, but it normally doesn't have too much of a negative effect.
Okay. John Fateki says, what do you rely on to validate the gross income of an applicant? Because bank statements show net pay. Is the applicant's pay slips, or do you also rely on income reported to HMRC, as this may vary?
Yeah, so it's normally payslips and bank statements. Sometimes we do need to see what's reported to HMRC, but it really does depend.
Okay. So I guess we'll take five more questions. We have a lot of questions, but just five more and then we'll wrap it up. We have one from Grace. Says, is it a good idea to pay in cash?
I guess if you've got the cash, so I wish we all had that. But if you've got the cash, I guess you then aren't paying interest. You're not paying any kind of fees associated with the mortgage. The issue with that is you wouldn't get the free valuation the bank does. So you'd have to think about doing your own valuation. That's a very important consideration. And whether or not that's the best use of your cash depends. If you could get more interest for that money than what the mortgage interest rate would be.
Okay. Taiwo says, is the cost for the legal process, inquiry, survey, etc. catered for by the lender or the borrower?
No, so the cost for the legal process is well, okay, to answer your question, it's the borrower. So it's not the lender, it's the borrower. So that would be yourself. Just as a rough guide, legal costs, including solicitors' fees, are normally about £1,500 to £2,000, somewhere in that region.
Okay. Then Linda says, can up to three persons buy a property?
Yeah, yeah, they can. Three people can. They can be on a mortgage as well. They can all be on the mortgage using all three incomes.
Okay. I think Max, a follow-up question. It says, are you saying for a new property that costs 350K, you only need to have 5% of that amount to secure a mortgage?
Depending on your situation, it is possible, and it's possible even whilst being on a visa, but it comes down to length of time in the UK, the type of visa, credit profile, and also the income side. So that third pillar I mentioned to do with affordability too.
Okay. I think we'll just take two more and then we wrap it up. So this is from Ifine. It says, can one deposit more than 10%?
Yes, you can. The interest rates that you'll have available to yourself will actually get better at 5% increments. So if you go from 10% and can get up to 15%, you will get better interest rates. If you get up to 20%, you'll likely get better interest rates as well.
Okay. Okay, we'll take this one from Adedeji Ojo. It says, if you decide to sell the property, I have a question regarding lifetime ISA. If you decide to sell the property purchase using the lifetime ISA, is there any issue with the government considering they contributed through the 25% bonus?
As far as I'm aware, there's no issue. No, they're not going to come back and take the money back. It's just a bonus, but you have to be buying your first home with it initially. Yeah.
Okay, amazing. All right. I know, I know a lot of
It's
people
skipping my
still have many
question.
more questions, but do we have time? I don't think we have time. Supposed to wrap up at 5.
Okay. I'm happy to, but it's up to you.
Okay, I think we can take one more because Adedayo says, would you advise we buy as an LLC or in our name?
So it means limited liability company. So a company structure. So as a home, if you're buying a home to live in and you're using a mortgage, you can't use a company, so you can't buy it in a company. So it has to be in your own name. People quite commonly buy buy-to-lets, so investment properties under company structures, which have certain taxation benefits. But for your own home, it needs to be in your own name.
All right, thank you so much. Thank you so much, Ripley. This has been quite insightful. I believe that everyone on here has been armed with the necessary knowledge to go into owning and buying their home. And like I mentioned, or like Ripley mentioned, you can book a consultation if you're close to the process of buying a home with him. Just visit his website. I think it's First Time Finance. It's pinned up here in the comment section. Yeah. All right. Thank you so much, Ripley. Yes, so just before we wrap up, we'll just do the giveaway. But before we do that, for people that joined us in the middle or towards the end, if you're not already using LemFi, please download the LemFi app. It's available on your Apple Store or your App Store on iPhone. And if you download the LemFi app using the referral code webinar, you get a £10 cash back on your first transaction above £50. So please download LemFi and you can find your buddy. So up onto the goodie box. Like I mentioned earlier, 5 people would be winning goodie boxes, and all you need to do is answer a question, and you stand a chance to win a goodie box. So quick one, what's LemFi's rate as at right now? Just drop your answer in the comment section. I'll pick 5 winners. What is the exchange rate on LemFi UK to Nigeria right now? All right, I guess we have a first. Okay, then. The current one. So we have, wow, you guys are quick. First person is Olutai Oladokun. Okay, congratulations. Naomi Urabo, congratulations. Kunle Udujaru, congratulations. And then we have 2 more people. Mark Darlington, congratulations. And John Fatuki. Congratulations, guys. So John Fatuki, Magdalene, Naomi Irabo, please drop your email address in the comment section. I'll reach out to you so as to collect your goodie box. Just drop your email address in the comment section. think the first person was Adoko. All right, thank you so much, everyone. Please drop your email. I'm just going to wait just 2 more minutes for the winners to drop their emails. Yeah, Jen Fatiki, yeah, Magdalene, Naomi Rabo, and Kunle. Yes, the recording of the session will be available on YouTube. For those that joined in late, you can go on YouTube at Use LemFi to watch the recording and catch up on everything that was said. Yes, it'll be available on YouTube. Thank you so much once again for joining, and do enjoy the rest of your evening. Thank you, Ripley. Bye for now.